Okay, good evening. Welcome back to today's class. Hope you are doing fine. How is everything going? Let's take some time and exchange pleasantries. Not every time will be serious about learning. It's all right. To your first question, please. Today, before I go into the questions proper, today we are going to talk about buyers and sellers in the market because I think I understand where you are having issues. We are going to talk about buyers and sellers, and we are going to talk about the Japanese candlestick. Yes, we are going to talk about the Japanese candlestick. So I told you basically we have three types of charting system charts. We have the line chart, we have the bar chart, and the Japanese candlesticks. Our focus will be on the Japanese candlesticks because it shows clear opening and closing of market prices. Okay, so we are going to talk about buyers and sellers. We are going to talk about Japanese candlesticks and forgotten. Okay, is there a third class? Let me see. Okay, all right. So, I back to your first class. What do I mean by 5 minutes time frame? So, like I told you, every candle in the market is represented by a particular time frame. You will be the one to choose the time frame. You understand? So, this is MetaTrader 4, for example. We have M1, like I've explained. Go back to our previous courses. You are going to see M1 meaning 1 minute, M5 meaning 5 minutes, M15 meaning 15 minutes, M30 meaning 30 minutes, H1 means 1 hour, H4 means 4 hours, D1 means 1 day, and we have the weekly chart also and the monthly chart. Okay, this is it on your MT4. Look at it by the side. All this one I'm just be shouting. M1, M5, M whatever it is. Okay, so that is it there. Right now, the time frame you are selecting will be boldly shown on your trading platform. Look at it. Euro USD, which is the currency pair. And then this weekend, you can see the market is paused already. Okay, market should resume any moment from now. This is 22:54. All right, market will soon open. So this is Euro USD M5, 5 minutes time frame, meaning every candle here is 5 minutes. It took 5 minutes for every candle to form. 5 minutes, 5 minutes, 5 minutes. Every candlestick you are seeing, no matter how big or small it is, it's formed within a space of 5 minutes. Okay, if you change it to H4, this is H4. I've changed it to H4, which is 4 hours. It means it took 4 hours for this guy to form. It took 4 hours to this fan to form. It took 4 hours. No matter how big or small, it took 4 hours for every candle you are seeing here to form. If you change it to 1 day, it means that every candlestick is a daily candle. It took 24 hours, which is 1 day. Okay, so this is you can see this candle form within a day. 1 day, 1 day, 1 day, 1 day, 1 day, 1 day, 1 day. So if you want to count for 1 week, now this is 1, 2, 3, 4, 5, 6, 7. So from here like this is 1 week candlestick. Okay, but you can also change the time frame to 1 week also. You can also change it to 1 week candle. You can even change it to 1 month, but there's no yearly one. The highest is 1 month. You can start from 1 minute. Okay, so let me change it to 1 minute. M1. So this is 1 minute candle. All these candlesticks you are seeing here, it took 1 minute, just 1 minute for each and every one of them to form. It took 1 minute for this guy to form. 1 minute, 1 minute, 1 minute, 1 minute, 1 minute, like that. 1 minute. Okay, every candlestick here, irrespective of the size, it took 1 minute for it to form. So that is what I mean by the time frame of 5 minutes. So if I say 5 minutes time frame, I mean that I changed it to a 5 minute candle. That is, each candlestick is 5 minutes. Each candlestick is 5 minutes. Okay. So, and the other question of yes, you can open two positions on one candle. You can open two positions on a particular candle, but that is not what I'm talking about. I'm not telling you to go and open a you should buy and sell. I will talk when we get to risk management. Like I told you, I will show you what it means to enter a buy stop. We have 4 types of pending orders in the market. We have buy stop, we have sell stop, we have buy limit and sell limit. Okay, we have buy limit, we have sell limit. I've already introduced this concept already in our previous classes. We have buy limit, we have sell limit. We have buy stop, we have sell stop. So those are the 4 pending orders we have in the market. Okay, so should in case of fundamental, if you want to be a fundamental trader, by looking at the global news events that is happening in different regions of the world, then you will be using a buy stop and a sell stop, because all you want to do, you are capitalizing on the fluctuations of the market. Okay, so for now, if you listen to what I'm telling you, what I told you in the last class, avoid trading during big news events. Avoid it, but I am going to show you how to capitalize on it, but avoid it. Okay, hope it's clearly understood, please. So what I mean by what you were trying to ask, the question you were trying to ask, you cannot buy in both candlestick at the same time. So what are you now doing? If the market is going up, you can either choose to buy. If the market is going down, you can choose to sell. Now, in respect to the last question you asked, that if the market is going up, you just buy, that you cannot sell. No, you can also sell. Market changes direction at any time. Okay, now this is a live chart. In this scenario, this particular trend started from here, and then it goes up like this. Upon reaching this particular level, the market changes direction. So if you are within this particular region, what is expected of you is to be a buyer. You understand? So if the market now changes direction, like now it is going down from that level now, here like this now, you are going to sell. But you will not know that the market is changing direction. That's why I tell you that trading is not mathematics. It is not mathematics. 10 years ago, mathematics, 1 plus 1 is equal to 2. Today, 1 plus 1 is equal to 2. Next tomorrow, 1 plus 1 will still be equal to 2. In the 100 years time to come, 1 plus 1 will still be equal to 2. You understand? So this is not mathematics. That is what makes it difficult. And that is also what makes it easy. With sound understanding, it is easy. With shallow understanding, it is difficult. Because if you are on a live chart like this is a live chart. Just look at this particular area. The market keeps opening from here. New candles keep coming out like this. Look at the next. Let me zoom out again. You can see now the market just opened. You can see the market has just opened. This is 23:01. So if you look at the timing that I told you about, you see that the market is opened exactly the same time I told you. You can see the market just opened for the new week. So every candle, you have not seen the previous candle. Now look at this present candle. Let's say you are on this market now. You are here. Currently, this is a market, right? This is the last candle, green. right? Now let me move this slightly. I will the next can coming, hold on, just a minute please. I think I'll need to switch to the what is it called, to the IQ broker platform. Okay, so just hold on, give me 2 minutes please, or 5 minutes rather. Come back. Okay, so I've switched to the platform. All right. So back to your question. I'm just trying to see how I can respond to all of those questions before we can proceed, please. So, like I told you, in this market, you are one man acting in two different conditions. Okay? You are just a one person acting in two different conditions. You act as a buyer when it is favorable for you to buy, and you act as a seller when it is favorable for you to sell. So either way, you are in business. You can buy, you can sell. Okay? So you can buy when the market is going up. Like this is an uptrend. Okay? Let me zoom out. Okay, let me zoom in. So if you look carefully, from here to this particular area like this is an uptrend. Okay? And then you are expected that as this market is shooting up like this, you are not supposed to go against the trend. You are supposed to be buying. Okay? Let me look for a downtrend scenario. Now look at this, is a downtrend. This is a minor downtrend for the overall market situation. Now from here like this, the market was going down. Okay, so as this market is going down, you are expected to be selling. But once the market gets to this particular level, it shoots up. It started to go up like this. As it gets to this level like this, it started going down like this. It started going down. So you can see that the market is moving in waves. It is going up, it is going down. It is moving in waves like this. Okay, it goes up, it goes down. So this is how the market moves. So that's why if you switch it to line chart, you will see, realize that this is how it moves. Let me change it to line chart. You can see. So you can see that the market moves in waves. So this is just it. This is it. Look at the market movement. So the market moves in waves. Let me take it back to our candlesticks. So you asked the question that if the market is going up, you will just be buying. You cannot do anything again. If the market is going down, you will just be selling. You cannot do buy. No, it's not like that. It's not like that. As this market was going down, from this area here, you can sell, and as the market starts going up, you can buy. You can exit this particular trade already and know that, oh, the market is going up now, let me be a buyer, let me start buying. You understand? It's as simple as that. You can exit that trade and change direction and buy. Okay, talking about placing one trade in a particular candle, it depends on the time frame. Like this is 1 minute candle. Let me change it to 1 day. I've changed it to daily candle. Everything you see here represents 1 day. It took 1 day for every candlestick here to form. Every candle you are seeing here, it formed within a day. That is 24 hours. It took 24 hours for this guy to form. 24 hours. No matter how big or small it is, it took 24 hours for it to form. Let me show you something. Let me zoom out. Alright. So you can see clearly. Look at this particular candlestick. It's formed within a space of 24 hours, which is 1 day. Look at this particular candle. It also formed in a day, but their sizes are different. So it all depends on the strength of buyers and sellers in the market at that particular time. We determine the formation of each candlestick, because the market moves with sentiment. There's what to call market sentiment. I think I'm going to talk about that. There's what to call market sentiment, traders' emotions. You understand? So that the market moves like that because this is real life scenarios. I've already told you about it. So irrespective of the size of this guy here and this guy, they all formed within 24 hours. Okay? Look at this particular one too. It formed within 24 hours. Imagine for good 24 hours, this is what the market was just doing. Okay? So that is what I'm trying to explain to you. And now talking about buying in a particular candlestick, like I said, it depends on the time frame. If you open a position on a 1 day time frame, the movement of the market will not be the same thing like that person who opened the position for with a 5 minute time frame, because it's 1 day, 24 hours is longer than 5 minutes, right? So that means the candlestick for 1 day will take longer for it to form than for somebody who is in the market who opened the time frame of 5 minutes. So a 5 minute candlestick represents 5 minutes. A 1 minute candle represents 1 minute. Okay, let me change it to 5 seconds. I think that is the least here. But on TradingView, you can get up to like 1 second, if I'm not mistaken, when you have a premium account with them. Okay, so this is 5 seconds. Everything you are seeing now is forming within a space of 5 seconds. You can see how fast it is moving. You can see. Now, if you look at this scenario, let me quickly draw this before it moves. If you look at the market goes up like this, it goes down, goes up, it is going down. Now, the candlestick are forming. You are seeing they are forming gradually, but do you know the next candle? No. Let's assume we don't know for now. Okay, let's assume for now we don't know, because I'm going to show you how you will know. So the candles are forming gradually. They are coming out within a space of 5 seconds, within a space of 1 minute, within a space of 5 minutes, within a space of 15 minutes, within a space of 30 minutes, within a space of 1 hour, 4 hours, 1 day, 1 month. Okay, let me show you the 1 month candlestick. Look at 1 week, 2 hours. Look at the weekly candle. Each candle here you are seeing took 1 whole week for it to form. 1 complete whole week. This is a strong green candle. It formed within 1 week, this particular candle. And this is a small candle within a week. Everything here. So if you want to look at how many weeks it is, this is 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks, 8 weeks, 9 weeks. If you start counting from here, it is 9 whole weeks. That is 2 months plus. This is what we have for the past 2 months. Okay, now this strong bullish candle, for the fact that you are seeing a strong bullish candle within a week, that means if you change this particular, if you are checking this market for a day, it's going to be a strong bullish trend. This is not a small candle, because this is a higher time frame. Let's see 1 month. Now we are on the monthly chart, 30 days. Okay, 30 whole days now. So this candle formed within 30 days. This one too formed within 30 days. Imagine in 30 days, this is what we are saying. In 30 days, this is what we are saying. Okay, hope you are getting the point. All right, so in 30 days, look at the differences. So the candle can form with any size. Okay, so let's just go back to our 1 minute so that I can explain the concept. So you can see, if the market is going up, you can buy. Once you you can buy, and that is why we have exits and profit. Well, that is why when I get to risk management, I'm going to show you that one. So you don't just open a position and leave it like that to continue to run. No. If you open a position, you are supposed to put where you will take profit. Okay? You are supposed to put where you take profit. Automatically, once the market gets to that level, it will exit you. Okay? Now you are seeing a strong uptrend. And let's say you enter the market from this particular area here. From here. And then the market shoots up like this. And you can decide that, okay, once the market gets to this area, I want to take my profit. You set it automatically. Once the market hits that place, it takes profit. It's going to exit you from the market automatically. You'll be out of the market. Okay? So, and they also have stop loss. That is, if the market is going against you, let's say you are selling at this particular time, okay, and then you enter your sell order from somewhere around here, and then you put a stop loss around here and say, okay, should in case the market goes below this level, it is going to exit you automatically, meaning you are going to leave the market. So when we get to risk management, we'll talk about that. So yes, if you are opening a trade for either positions, either buying or selling, it depends on the time frame, it depends on the candlestick. That's why I told you in our second class, if I'm not mistaken, or in our first class, we have 4 types of traders. We have day traders, we have swing traders, we have position traders, and we have scalpers. We have scalpers, day traders, swing traders, and position traders. The scalpers are the ones that take trade within 1 minute, 5 minutes, at most 10 minutes. The day traders take their trade within a day, 30 minutes, 1 hour, like that, 2 hours, 4 hours. Position traders take trades within a week. That means the trade is going to run for this particular period I'm talking. It's going to run for 1 week. You understand? While swing traders take their trade 1 month, 2 months, up to 1 year. That means if they open a position for the next 1 month, it's going to be running. You understand? So you cannot buy. If you want, that is, you have to be decisive in the market to buy or to sell. So yes, you can open a position for in one candlestick, but there is what we call break even. You are going to be in break even. Let's say this is a bearish candle, of which it is, and then you sold from this level here, and then you are now buying from this level again. What is the essence? There's no point, you know. So concerning that, concerning the fundamentals I'm talking about, you are capitalizing on the volatility of the market. You understand? If you notice, the market made a very long candles like this. You understand? So that's why I say, if you enter what we call buy stop means if the market gets to that your area, it is going to buy and move automatically. So let's say you place your buy stop order here, and because of the volatility of the news, the market shoot up. As you enter your buy stop there, the market enter, and let's say you put your take profit somewhere around here. If it hits the take profit, automatically you have leave the market. From this space here, you calculate the number of pips. You don't need to, it is already automated, so you just see your profit. If you enter a sell stop order, you enter a sell stop, let's say you enter your sell stop somewhere around here, and then the market shoots down and you hit your sell stop, you enter a take profit somewhere around here. You understand? It's automatically like that. Okay, so let me do it on a live. Let's see. I can't. This one we can only explain. Except I see a high volatile candlestick that I can just use to explain. Let me see. Let me see if I can get a good Okay, this is over. This is OTC market, over the counter. So we may not see any institutional candle. So that trick can work only on institutional candlesticks. So let's assume this is an institutional candle. This is an institutional candlestick. Candle that will occur as a result of big news events in the market. Okay. So it is the same thing, just like the way I showed you in that particular course. You are capitalizing on the volatility, because if you notice the market was just moving up and down, up and down. You understand? It shoots up, it shoots down, it shoots up, it shoots down. You understand? So you are capitalizing on the volatility. You are capitalizing on the movement. You understand? That is the only way you can. That is one of the easiest way you can profit from news. Okay. So technical analysis, you are studying the past market history. You are looking at the history. What has the market done in the past for you to determine future results? Okay. So for this situation now, you look at it that, okay, at this time, you bring out a horizontal line, place it somewhere around here. Okay. Let me make it bold and black and bold. Okay. You place that horizontal line here. Now, because you have learned what I taught you, you know that the market is moving. Anytime it gets to this level, it goes up. It gets to this level, it goes up. It gets to this level, it goes up. These are your entry points. This is where you'll be entering your trade. You see these two situation here. The next time, now you are waiting for the market to get to that level again. Now you get to the level, you enter your trade here. Okay. And maybe you have already you enter your lot size, enter your the amount that you want to enter as a lot size. Okay. And you may put your take profit somewhere around here. And once the market hits that level, you can just put it and go and sleep and leave it there like that. It's going to execute by itself. Okay. And this is another area again. The market gets to this level again, it shoots up like that. So this is technical analysis. Now this is the past history. This two now is the past history. This first two is the past history. Now you are studying this history here to predict what will happen in the nearest future after seeing this particular market. You are expecting that the market will come back to the same level, and once it gets to this level, you are expecting the market to go what? To shoot up. So this is technical analysis, using past history to predict future results. Okay. So this one is for horizontal line. We'll look at a situation where we need to draw a trend line. So this is why your eyes now need to be very sharp. You need to look, okay, what is the market? Now I'll tell you all the different types of market situation. Is the market a trending market or a flat market? Now look at this situation here now. Look at this situation. You can see this is a different example. Let me make it black and bold so that you'll be able to see clearly. Alright, hope you can see this. Now, look at this situation carefully. The market moves like this, like this, like this, like this, like this, like this. These are your entry points. These are where you're supposed to be entering the market. Like this, whenever it hits that level, or whenever it gets to this particular level, like this. This will be your entry points. This is what we call a channel. These are your entry points. Now, where is the past history? The first two candlesticks you are observing in the market. I mean, the first two pattern. Okay. This first two situation here is the history. The first time the market got to this level, it reversed. It gets to this level again, it goes down. So that means you are going to you have now drawn your trend line like this downward. So that means you are waiting for the market to hit this level again. Once it hits that level, you are expecting it to go down. This time around you are going to enter your trade, and you can see it is going down, and you put your take profits at a particular level somewhere around here. Okay, so you can see that trading is all about at the end of the day is experience and psychology. So it's what I'm trying to teach you. Okay, so I believe your question has been answered, please. I believe I have answered your question. So if the market is going up, have it in mind, you'll be a buyer. If the market is going down, you'll be a seller. It's not because that the market is going up, you will only buy, you cannot sell. No, that is where you now lose. If the market is going up, instead of you to buy, you are now selling. You can see that you are in the wrong side of the market. You are going to be in the negative side. And then if the market is going down, instead of you to be selling, you are now buying. You are the wrong side of the market. You understand? So it doesn't mean that because the market is going up, you would only be buying. No, you can also equally sell. But before you sell, you have to take calculated analysis. You have to do your analysis to determine, am I supposed to sell or am I supposed to buy? Okay. And then you can open more than one trade in a particular candle. You can open 2 trades, you can open 100 trades in a candle. It all depends on your capital. Okay. And the other area, when I say that liquidity will be taken out, you don't have any, that is a trading terminology I used. You don't have any business to do with liquidity taken out. You are not taking out your own liquidity. It's the market that is taking out liquidity. You are not the only trader in the world. We have millions upon millions of traders trading all over the globe. Okay, trading all over the globe. And then let's say, for example, now you are looking at, as a trader, you are looking at this particular zone here. Okay, you are looking at this particular zone. Let me make it bold and black. So as a trader, you are looking at this particular zone. That's okay, that is a strong seller's zone. And then you are expecting, once the market moves like this, you are expecting it to hit this particular zone and then go back again, just the way it did here. It sold off. You are expecting it to sell off when the market hits this particular zone. You are expecting it to go down. Okay, but as upon reaching that particular area, because every trader use what we call stop loss. Okay, if the market is going up or if the market is going down, you are supposed to sell. Now the market is, you are expecting the market to go down at this particular area. While it is going up, you are expecting it to hit this level and also go down. So should in case you are wrong, that is why you put what we call stop loss around your here. You put stop loss, stop, loss, normal stop, and then LOSS. You are trying to say that once the market gets to that area, that means if your prediction is wrong, the market, your broker should exit you. Okay, your broker should exit you. And if your prediction is right, it's not going to even hit your stop loss. So that stop loss is for you to remain safe in the market, to still have your capital back. You have $100, you have opened a position of $5. You have put stop loss of minus of let's say 2%. So that means if the market is going against you, just by what you have used to open the market, the trade automatically is going to exit you, because the market is supposed to go in your direction. Okay, the market is supposed to head towards your direction, not against your direction. If the market is going against you, you are in loss. You are going to be losing your capital. But if it is going in your favor, you'll be making more money. So have it in mind that the market will fluctuate. So whether it is going down, you just hold on, it will go up again. Let's say you buy. If you sell, it is going up, you hold on, it's going to buy, provided it has not hit your stop loss. Provided the market has not hit your stop loss. This is going to be a little bit long lesson, so I'm still answering your questions. Okay, so now, as this market, so let's say you enter a trade now with this particular, with this candle, you can see that the market broke the line, made another bearish candle before it started going down. That's what I mean by liquidity will be taken out. It's because a lot of traders out there will set their stop loss somewhere around here with this exactly at the line, but the market will now break the line. Even though the market is supposed to actually reverse from this particular area, it's supposed to go like this and go down. Okay, but before it goes down, it is going to take out liquidity. Let me draw some charts. The market is moving like this. You are expecting the market to reverse from this area, right? And then the market suddenly reaches the area and then goes up, and then finally it goes in the right direction that it's supposed to go. This, what just happened here is that it has taken away liquidity from other traders. So for those who have a very tiny stop loss, that's why you need to allow the market, your trade, to breathe. You need to open a good position, allow your trade to breathe, in the sense that give a good stop loss. So I'm going to teach you how you enter your trade. Don't trade more than 5% of your capital, and at least target 2-to-1 ratio. That means you are losing, let's say 2-to-1. Let's say you are opening a trade of $5. Right? The 5, and you are 2-to-1. That means, or let's say 3-to-1. So 3-to-1, you are targeting $15. Okay, so that means you are risking $5 to make $15. The $5, you are going to put it as your stop loss. So if the market is going against you, you only lose $5. But if the market goes in your favor, you are going to make $15. Okay, so that is what I mean by liquidity will be taken out. The market will just go up, cancel all liquidity of other traders. You think, why is the market going up? It's not supposed to reverse. Before you know, it goes down again after taking out all the liquidity. So that is where experience comes in, and that is where skills comes in. That is where a lot of people will now look at, this thing is not working now. This is not what they taught me is not working. No, the market is not mathematics. The market presents itself in different dimensions every blessed day. That is why in this business, at the end of the day, after you have learned everything, you start practicing. At the end of the day, the only thing that will make you profitable is experience. Because the market presents itself in different ways. Okay, so I think I've done justice to all your questions, please. So now let's talk about the Japanese candlesticks. Alright, let's talk about Japanese candlesticks proper. So like I told you, in the market, you are a buyer, you are also a seller. You are a buyer if the market is going up, you are a seller if the market is going down. Okay, that's why I say we are going to talk about buyers and sellers. So in this market, the green candle here represents the buyers. This green candle represents the buyers, while this red candle represents the sellers. So that means for each time you are seeing a green candle, it means the buyers are in control. The market should be going up. If you are buying, the market should be going up like this. Okay, and for each time you are seeing a red candle, the market, you are expecting these sellers are in control, meaning the market is going down. Now, these are just elementary analysis. You understand? For newbies in the space. Okay, for newbies in the space. You can change the color of this candlestick to white. Like mine, like I always tell, is black and white. You can change it. The white represents the buyers, the black represents the sellers. So you can change the color to anything. But for learning purpose, we are using green and red. You understand? But what I'm trying to tell you in essence is that it is not just stick to that, like because that if it's green. So that in case you are seeing a professional trader's chart and you are looking for the green candle, we wonder where is the green candle? They told me green candle is for buying and the red candle is for selling. Where is the red candle? Where is the green candle? You understand? The person has changed the settings of his own to suit himself. You understand? Just for fast fancy. You get? So it's like that. Okay, so this is the anatomy of a Japanese candlestick. So the Japanese candlestick is used to measure price of the commodities in the market. Let me just explain it that way. In the sense that, like I will always tell you, if the prices are going high, that means the buyers are in control. You should be buying also if the market is going up. If the price is going down, you'll be seeing downward trend. You will be seeing bearish candlesticks mostly. So that means if the market is going down, mostly what you'll be seeing, sellers will be dominating in this, irrespective of the fact that you'll be seeing slight fluctuations in the market. Sometimes buyers will enter, but just like in previous charts that I've shown you, you will see an uptrend, but in between you are seeing bearish candlesticks. Okay, you will see a downtrend. In between you are seeing bullish candlesticks, but it is a downtrend. Uptrend is uptrend, downtrend is downtrend, because the market fluctuates as a result of economic activities in that region, or in the currency pair, then in the country where it is being used at that moment. That's why I tell you the market moves in waves. So let's see the anatomy of a Japanese candlestick, please. Okay, so this is a typical Japanese candlestick. The green candle, we call it bullish candlestick, and then the red candle, we also call it bearish candlestick. Okay, so if you are seeing a bullish candle, the market is going up. If you are seeing a bearish candle, the market is going down. Now look carefully at these candles. You will see a line above. Look at that line. Look at this tiny line above. Tiny line, tiny line. And this is, look at this, where the body of the candle is. Look at this, the body of the candle. Okay, so we are going to see a live market also, so that you can see how the market, you can see what we are talking about. So this is the high. This is also called wick. It's also called wick. W-I-C-K. Wick, or shadow, like normal shadow. Okay, so this small line you are seeing here can be referred to as shadow or wick. All right, so the upper shadow is called the high. Let's focus on a bullish candle for now first. So this is a bullish candlestick. So you can see the upper shadow or wick. It is the high, and the lower shadow is called the low. What does that mean? Tells you. It means that when this bullish candle, bullish candle always go up, right? So that means look at it, has an opening price here and the closing price above. The bullish candlestick always open from below and goes up. The candle opened from this side, it came down to this level and then shoot up again, got to this high, rejected and closed at this particular area. So For every area the candle has reached, for every high the candle has reached, it must leave a sign known as a wick. It must leave this wick, except if the candle has not gone to that high. But we have smooth candlesticks that will just form like this. You will not see anything like wicks above like this. You can't see any wick like this. Okay, those are what we call marubuzu candlesticks. It has a name, marubuzu. Marubuzu. All these candlesticks, they have names. We'll get to that point later when we start talking about the names of these candlesticks. Okay, so the candle for the bullish candle, it's open at this particular area and goes up. It got to this particular high and reverse again, and then finally it closed here. That's why we call this is the closing of the candle and this is the opening of the candle. So just have it in mind that for a bullish candlestick, it opens below and goes up. So the opposite is the opposite for a bearish candlestick. Okay, the bearish candlestick opens above and goes down. This is the opening price here, opening price, and then it goes down and gets to this particular level, and then finally it's rejected and closed here. This is the closing price of the candle. So for a bearish candle, or a red candle, or a selling candle, the market opens above and then goes down. For a bullish candle, the market opens below and goes up. Okay, so for any of these bullish candlestick cannot open above and go and start going down. It must open below and shoot up, because it is going up. It's like a tree that you plant. It starts from the down and goes up. By the time you cut the tree, it falls from the top to the down, to the ground, sorry. And for every point the candlestick gets to, it must leave a wick, it must leave a wick. And this wick occurs as a rejection of prices in the market. We are going to get to that aspect too. The wicks occur as a result of rejection of prices in the market. But for now, just understand what a Japanese candlestick means. So this is a bullish candlestick representing buyers. This is a bearish candlestick representing sellers. The bullish candlestick opens below and then goes up. For the bearish candlestick, it opens above and then goes down. The reason why you are seeing this shadow here, or this shadow here, shadow or wicks, you call them shadow or wicks, it is because as the candlestick open, for example, like this is how the candle moves. You can see it goes up like this. So let's say as the market opened from that area, it goes up, close at this particular, it goes down like this, and then it now goes up again and close back. It is going to leave a small sign below known as a wick or shadow, telling you that the market got to this particular low before it's rejected and closed. Okay, so that is a Japanese candlestick for you. To observe this very well, you will need to see a live market chart. So this is another slide showing Japanese candlestick. Now let me show you something. This is a bullish candle, a green candle, right? This is a bearish candle. This is the high, this is the opening price, this is the low, this is the closing price. Everything that is left of the candle is called the body. They're like this. Anything aside from the wick is called the body of the candle. Like this, all this area is the body of the candle. aside from the upper wicks and the lower wicks. It is called the body of the candle. Let me draw a candlestick. This is the candle. Just imagine this is a candlestick without shadow. So what you are seeing here like this is known as the body of the candle. Okay, so by the time the candle form like this, it got to this level and then it goes up. It leaves a wick above. Sometimes there is no wick above or below. It depends on where the rejection is coming from. Leave wicks like this. So these wicks are known as shadow or wicks. This line, they are known as shadow or wicks, while everything inside here is known as the body. So as you can see here, this is the body of the candle. Okay, so this is a bearish candle, this is a bullish candle. A bearish candle or a red candle represents sellers. A bullish candle or a green candle represents buyers in the market. So this is another slide. So you can see carefully that this is a bullish candle, this is a bearish candle. The market open here, it goes down to this particular wick level and then finally shoots up, go to this level again and finally goes down and close at this area here. So all this entire of this area is known as the body of the candle. This is the body of the candle. Same thing with the bearish candle. This is the upper wick or upper shadow. This is the lower wick or lower shadow. Lower wick, lower shadow. Lower wick, upper shadow. It occurs as a result of price rejection in the market. Now let's go back to a live chart and see these candlesticks. Let me open a 5-second chart so that we can quickly observe how the market is forming, or let's leave it as 1 minute. Okay, so now this is a real market chart, a 1 minute candlestick. A 1 minute candle. Each candle here, it took 1 minute for it to form. Okay, so now look at the current candle. Let me zoom out. Okay, look at the current candle. Okay, let's say before we look at the current candle, let's look at this bearish candle. You can see it represents sellers. Can you see the upper wick or upper shadow there? Can you see this is the upper shadow? This is the lower shadow or lower wick. This is the body of the candle. The entire of this area is the body of the candle. Okay, so let's look at the bullish candle. This is a bullish candle. This is a bullish candlestick. Look at the upper shadow or wick. It means the market got to this high and rejected and then closed. This is the upper shadow. For this bullish candlestick, the market opened at this area and goes up, got to that point and then rejected and closed. For this bearish candlestick, the market opened at this area, it goes down, got to this level and rejected and goes up and then finally close at this particular area. Okay, so now let's see a current candle that is forming. So you can see the current candle. Now look at this current candle now that is forming. Just look at the behavior. You can see it is going up. It is every area this candle will reach, it must leave a wick. That is if the candle rejects and close. But if the candle doesn't reject and close, it will not leave a wick. You can see. This candle will close in 1 minute because this is a 1 minute candlestick. Okay, now you can see a strong candle. Look at the candlestick. It may close as a Marubozu candlestick. A Marubozu candlestick is a candle that has no shadow, no upper shadow, no lower shadow, or upper wick or lower wick. Now if we are seeing rejection, you can see the market got to that high and it is going down. You can see it leaves a wick. So now let's use it as an example. Now that after 1 minute is done now. Now look at the candle. Look at this candle that just finished. It opened at this particular area. It goes up, got to this high, rejected from here. You can see the upper shadow, and then finally close at this area. Now look at the current candle that is forming now, a bearish candle or a red candle. You can see it is rejecting, and you can see any area wherever the length of the candle got to, it must leave a shadow. And most of this shadow occurs as a result of price rejection. Okay, the buyers are rejecting the price in the market. The shadow, a lower shadow indicates price rejection from buyers, and upper shadow indicates price rejection from sellers. Now look at the candle has finished forming. So now let's analyze it again. This particular bearish candlestick has finished forming. Okay, now the bearish candlestick opened above, right? It goes down, got to this weak level like this, and rejected and close and goes up and then close at that area here. So look at the shadow or the wick. Look at the shadow that the candle left. So that's the point I'm trying to tell you, that the candlestick, wherever the candle move, so long as it's rejecting, it must leave a shadow or a wick. Okay, it must leave a wick, like all this candlestick. It must leave a wick. Like this particular candle now, there is no, this particular bullish candle, if you notice, the rejection is only from above. There's no lower wick. Now this is the body of the candle. This is the body of the candle. Are you getting the point? So that is that. So that is how a Japanese candlestick behaves. So you can create an account on your MT4. Don't even press it. Just sit down and switch it to 1 minute. And just be looking at it. Or since you already have the IQ option platform, you can come to this area here. Once you enter your trader room, you can come to this particular area, select any market of your choice, and just, if you press it, you can see that options of the market will now appear. You can see, if you press it, we have different options here. Trading, we have options. Blitz, this Blitz was just newly introduced. Binary, digital, forex. If you go up, you see stocks, crypto, commodity, ETF, stocks, like that. And finally, watch list. The watch list is the market that you select to be watching by yourself. You want to see the behavior. So you can just create an account, open any of this trade, open any of this market, and just be looking at how the candles are forming. Okay, select the candlestick time frame. Is it 1 minute candle? So it's the same thing that is applicable even in 1 month candlestick. Even in 1 month, let me switch it to 1 month so you can see. So even in 1 month, you can see the rejections of the candle. You can see the wick. You can see the candle. You can see the body. You can see the lower shadow. You can see the upper shadow. You can see the wick in the candle. So this is Japanese candlesticks for you. You can drop your question anywhere you don't understand, please. Okay. So we are analyzing just individual candlesticks to explain the Japanese candle for you. But if you want to trade it, you combine many candlesticks, especially if you are trading on a lower time frame, like 1 minute, 2 minutes, 4 minutes, 5 minutes, like that. Okay. This is a candlestick that has just been formed at this level. So you can see, you can just be looking at the candlesticks the way it is forming. Okay, you can just be looking at it. So you can see now the market has opened. I'm now starting getting notification news events in the market. I just got a notification now, but I don't know what news it is because I've not seen the economic calendar for today. Okay. So each candlestick represents a particular time frame or a time limit. 1 minute candle represents 1 minute. It means this now is 1 minute. Every candle you are seeing here, it took 1 minute for the candlestick to form. Every candle. If you change it to 1 day, it means it took 1 whole day. All these things now you need to start looking at it. Look at a particular chart on your MetaTrader 4. Look at you can be looking at the candlesticks for one minute and see how they are forming. Then change it to 1 day. Look at the candle. Then after 24 hours, come back again and look at the next candle. You will see that the candle has changed. It took 24 hours for it to form. Or you may look at the current candle. What am I trying to say here? All this thing, don't get confused. I'm just telling you how you can just understand how these candles are being formed. Okay, like 1 day candle. Now if you observe carefully, I've switched it to the daily candlestick. Daily candle. It took 1 day for this candle to form. It took another 1 day for it to form. It took another 1 day for this candle to form. Okay. Now, but this is the current candle. This is the current candlestick today. So if you go to your MetaTrader for open Euro USD, look at your current candle. Although this is OTC, this is not a live market, this is a simulated market, but it's the same thing. Okay, that is the current candle. Until after 24 hours, when this candle will be done, they will now see the next candle that will form again. Will it be a bearish or a bullish candle? So you can see this particular last candle that is forming, then the next day come and see the next candle. But for 1 minute, so for 1 minute you can easily see, or let me even switch it to 5 seconds. You can easily see how the candlesticks are forming. So on the 5 seconds, you can see it's going to be forming faster because it's just 5 seconds. Every candlestick here took 5 seconds for it to form, no matter the size of the candle. You understand? No matter the size of the candle, it formed within a space of 5 seconds. Okay? No matter the size of the candle, it formed within a space of 5 seconds. Because I'm on a 5 seconds chart. I'm feeling sleepy, tired and exhausted. Alright, so I will leave you at this to go and study these candlesticks. So what I want you to do now is for you to indicate the buyers, the sellers. You can draw a Japanese candlestick, please. This is an assignment. Draw a Japanese candlestick. Indicate the wick of the candle. Draw the candlestick indicating the wick, the upper shadow and the lower shadow. Draw a bullish and a bearish candlestick, please, indicating the upper shadow and the lower shadow, or the upper wick and the lower wick. Okay, so you can draw it and so that you can better understand these things. So you can see these are 5 seconds candle. You can see how fast they are moving. You can see how fast they are forming. The candlesticks are forming. Okay, so right now we are not seeing much rejections in this particular chart. That's why the candles are forming without any wicks, or you can see tiny little wicks above. Let me change this currency pair. So all these are 5 seconds candle. You can see the body of the candle. You can see the upper shadow, you can see the lower shadow of the candlesticks. You can see this is how the candles are forming. For every level high the candle reach, or every level the candle reach, if it goes down, it will not leave that place blank. It will leave it as a wick or a shadow, telling you that market got to that level before it rejected and closed. Okay, look at the candlesticks. Look at the candlesticks. Can see. You can see. So you can just on your chart, switch it to 5 seconds. Just be looking at it so that you understand what I'm saying very well. Okay. So with this, please, let's call it a day for today. We'll meet in our next class. In our next class, drop your question. I know you have a lot of questions to ask in this topic. Just drop your questions, then I will try to answer each of them before we start our next class. Okay, so you can do further research on these candlesticks. Please go to YouTube, go to Google, search using the information I've given you, and then compare so that you can be able to understand very well what I'm saying, please. Okay, so it's all right. We are going to see you in our next class, please. All right, take care. Bye for now.